Hello and welcome to another edition of the Global Reset. For nearly a year now, investors have been discussing the potential for a second Trump presidency to quickly push Europe to provide for its own security. Remember that the Trump administration is pushing NATO members to spend 5% of GDP on defense versus the current 2.1%. NATO General Secretary Mark Rutte has called on the alliance, that is NATO, to spend over 3% of its GDP on defense, which would put the whole group on par with the US. Do remember that some NATO countries are already spending about 3% or more, mainly those closest to Russia. The laggards in the alliance, where the economies are also big enough to make a difference, are Spain and Italy. There is room in both these countries. Germany is right around the 2% average. Just for some context here, each 50 basis point increase in defense spending for NATO Europe is worth about $115 billion by some estimates. What is also becoming increasingly clear is that we are now shifting in a less constructive direction regarding a potential ceasefire between Russia and Ukraine, at least this year. After promises to solve the Russia-Ukraine war in 24 hours, later delayed to months, the US administration, the Trump administration, appears to be losing hope in finding a solution. Yesterday, the German chancellor said that Germany, along with Ukraine's other main Western supporters, will remove range restrictions on weapons delivered to Ukraine for the first time. Russia has, of course, called this a dangerous escalation. What does all this mean for European defense spending? Is European defense transitioning from a pre-Ukraine, pre-Trump level of percentage of GDP to a new higher level? What is the likelihood of structurally increased European defense spending? And what does it mean for defense manufacturers in Europe, the US, and here in Asia as well? To discuss all of this, joining me is Benjamin Heelan, co-head developed EMEA, Aerospace, Defense and Capital Goods Research at BofA Securities. Benjamin, it's a pleasure to have you with us here. Thank you very much for your time.
Thank you. Nice to be with you.
Benjamin, so that basic question, has something changed? How much of this is hype? Is this overhyped? Is this underhyped? Go on.
No, look, I think something has really fundamentally changed. And I think that what the catalyst was, particularly here in Europe, and in Europe, we've been seeing defense spending increase for a number of years post the invasion of Ukraine. But what the catalyst this year really was the European nations not being invited to those initial peace talks in Saudi between the US and Russia. And I think that was the point of realization for a lot of leaders in Europe, that Europe for a long time, the UK included, had relied on soft power in terms of how it operates with the rest of the world, and just weren't being taken seriously, right? And I think that was what we saw was the catalyst that drove all of these meetings that we've had subsequent. And I think that the realization that we've seen in Germany, that we've seen in the UK, that we've seen in France, just to name three, and you mentioned in your introduction as well that a lot of the Eastern European countries have already articulated a willingness and an ambition to go to over 3%. Finland going to 3.5%, Sweden going to 3%. A lot of the Eastern European countries are already at 3%, going to 4, 5, 6%. So I think that has been a real catalyst in Europe, the realization that actually Europe needs to stand up for itself. It needs to be able to defend itself, and it has allowed its defense industrial base to fall behind in terms of capacity, but also capability. Yeah.
And there is money to do this, Benjamin?
Yeah, look, I think what we are seeing is that the governments recognize a need to make those investments, and so the savings are being found from other areas. So here in the UK, as an example, we announced a cut to our aid budget, our foreign aid budget, as a way of supporting and financing the higher levels of expenditure in defence. There are some countries you mentioned too, Italy and Spain, obviously, that have significant deficits that haven't articulated as yet a willingness to go to 3% plus. And there are clearly going to be some of the countries within Europe and within NATO that aren't going to meet the 3%. I think if you look at NATO as a whole and you see that you have your Eastern European countries, Poland heading to 4%, 5%, maybe even 6%, a lot of the Scandinavian countries going to 3.5%, you don't need every single country in Europe and in NATO to be at 3% for the bloc as a whole to be getting to 3.5% plus. And I think that's something that's very, very important to take away, that there is enough money when you think about NATO as a combined group, but there are going to be some holdouts, definitely. The other thing I would say as well is I think there is a massive buy Europe mandate. The EU as a commission has recognized that Europe's defense industrial base has gotten to a level that it needs to start to rebuild in both capacity and in terms of capability. So a lot of what the EU Commission has done has allowed governments the ability to go out and invest in defense without defense being included in the deficit calculation. They're going to strip defense spending out of that deficit calculation in the EU in recognition of the urgency of the need to reinvest and get the spending levels up. So there's definitely been much more flexibility when it comes to the deficit side of things in Europe. Final thing I'll say on this is the EU has also put forward this 150 billion euro of cross-European spending to drive spending across the bloc in higher tech programs. And that money is not really just about capacity, it's about capability, because I think that when you look at Europe's defense industrial base, there's been a lot written in terms of how reliant we are on the US. Reality is, from a technological capability perspective, we do have a lot of leading technologies and leading edge capabilities in Europe, but there are a lot of stuff as well that we just do not have, and we are going to be reliant on the US for. And so the EU putting that 150 billion euro in place to drive that kind of cross-border investment, I think is a very, very important thing. Yeah.
I got that. Benjamin, if you have any estimates at your end, what was spent, say, on defense? How much did the EU spend on defense? What could that number go up by over the coming years? I mean, if you have some broad numbers.
Yeah, so Europe was spending roughly 1.5% of GDP in 2021, and at the end of last year, 2024, it was, like you mentioned in your introductory remarks, it was roughly 2%, just slightly below 2%. That's about 450 billion euro, of which roughly 20% was spent on actual kit procurement, right? Now, if you're going to go to 3%, that would be roughly 750 billion euro. If you're going to go to 3.5%, you're talking 850 to 900 billion euro, depending on how aggressive you want to be in terms of what Europe's growth rate is going to be. But that's the sort of step up that you are going to see. I think what's also important here is that the amount that is going to be spent on procurement is also going up. So when you think about Germany as an example, right? So Germany spent roughly 60 billion euros on defense in 2021. It had procurement spending of roughly 8 to 9 billion euro, so roughly 15% of the overall defense budget. If you believe in 2030, 2032, Germany is going to be spending 3% of GDP, that would be roughly 130 billion euro on defense. But it would be, if they spend roughly 30% on procurement, you're talking about 60 billion euro. So you can see why the stocks in Europe, the industry in Europe has done what it has done, because not only do you have growth in the defense budget, 450 billion as a block, going to 800 billion, 850, potentially even 900. But you also get this real compounded effect in terms of the amount that is going to be spent on procurement is going up as a proportion as well. And so that's why you're seeing the growth rates that we're seeing across the sector. We put out a piece last week looking at benchmarking all of the European defense names. 2019 to 2021, they grew, mid-single digit, 4-5%. They will be growing low to mid-teens in the next 4 years. And I think what you will also see is that 2027 through to 2030, there will be another acceleration in growth, because the orders that are coming today will only start to hit the P&Ls in 2027 and 2028.
That's very, very fascinating. So just to get those numbers right, I mean, so you're saying in 2000, last year, $450 billion was spent, 20% on actual procurement. So that's about $90 billion on actual procurement.
Yep.
So sort of capex in that sense, right? And that 20% will grow. But even if it doesn't grow, as you said, 3% would mean $750 billion. So 20% of that is $150 billion. So in any case, there is even if the kit procurement is 20%, and if you take the defense spending to be 750, there is about a 60-70 billion euro bump up that we are talking about as far as kit procurement is concerned. And of course, I mean, these numbers could be larger.
Yeah, look, the one thing I would say is I think it's very, very unlikely procurement spending stays at 20%.
Okay.
I think, if you look at the Cold War era, early 90s here in Europe, we were spending 30%, right? And I think that, there's any number of stats about operational readiness. And we have the NATO capability plan coming up at the end of June at the NATO summit in The Hague, where they will announce the capability plan. One of the big elements of that capability plan is going to be operational readiness, right? If you have 100 fighter jets, are 100 of them fighting fit and ready, or are 30 of them? And so I think what you will find is that a lot of the equipment in Europe has gotten to quite a depleted level. So I would be very, very surprised if procurement spending stays at 20% in Europe and the UK over the next five years.
Okay, I think that really sets the base for the next couple of questions. And I mean, very useful. Benjamin, where is this money going to be spent? Will it be mostly US defense contractors who will get more business? Could it be Asia? What's your sense?
So I think you have to break down what is Europe looking to achieve, right? So the first situation is just rebuild strength, and that comes down to volume, whether it be the volume of tanks, the volume of HIMARS systems, the volume of artillery, the inventory of artillery shells. So the first step is let's just have more stuff, right? And I think that there are a number of players in Asia that have very unique capabilities that have done very, very well in Poland, as an example. If you think about Hanwha has got some big contracts with Poland. So there is clearly a market if you have a capability to play in the European market. But the first step is going to be rebuild strength on the border in Eastern Europe and just have more stuff, right? The next leg and the longer term plan around Europe is how do you maintain a strategic edge and advantage over your adversary? And that comes down to, I think, a number of things. The first is going to be air defense, and that's going to be a combination of radar solutions with an effector in terms of a defense actually being able to take stuff down that is coming at you. There's also going to be a big focus, I think, on long range strike capabilities. So when you think about some of the more longer term advanced missile technologies that we have here in Europe and in the US, there's going to be a lot of focus on communications. So just how do you drive real interoperability? It's pointless having a radar system in Eastern Europe if it can't tell the pilot that is, running a sortie what is going on, right? So driving interoperability, and then logistics, right? It's pointless having a lot of kit if you can't get the kit to where it needs to be. So I think those are going to be some of the key capability requirements that come out of the NATO spending review in the coming weeks. In terms of the US, I think there are basically the US has leading kit, right, from a technology perspective. I think there are a number of capabilities. So HIMARS rocket artillery. So we just don't have a lot of that capability in Europe, right? We the European countries basically buy the Lockheed Martin HIMARS system, or they buy the Hanwha Aerospace and Defense system, and that's something that Rheinmetall is looking at building a capability, but that takes time, right? So that's one area that Europe is still going to be reliant on outside regions for a period of time. The second is going to be advanced missile defense, whether it be the Patriot system in the US or other forms of advanced ballistic missile defense. But there's going to be a big focus on missile defense, and Europe is going to need to scale its current capabilities. We do have capabilities in this area, but they are just not that high volume. So that's going to take some time. But also there's going to be a lot of investment in missile defense. The third area is stealth, right? We just do not have a stealth capability here in Europe. We are investing. There is a French-German program called Future Combat Air System. There is a UK, Italian, Japanese program called Global Combat Air. Right. Those programs will be ready the middle of the 2030s, late 2030s. But the European nations have been very reliant on F-35, and I think that reliance will remain at least until those European programs are ready. So those are the three areas I think that Europe is still going to be quite heavily reliant on regions outside of Europe.
No, I think a very, very exhaustive context there, Benjamin. A lot of Indian companies are also, of course, I mean, there is a big indigenization program here in India that, cut down imports and do what you can here, make in India in that sense. And I think as the recent conflict here at the border with Pakistan showed that, some of the systems have really done very, very well. What can Indian companies do, I mean, to tap into the market, in your opinion? Or you think it's going to be tough? What is your sense?
I don't think it necessarily is going to be tough. I think it comes down to where do you have a capability advantage, right? If the countries in India have a capability that is competitive on a global stage, then the countries in Europe will definitely look at it. I mean, if you think about the companies that I directly cover, Airbus and Dassault Aviation, etc., these are countries that see India as a core market. There's been a lot of investment into India as part of what you mentioned, that kind of building up of the defense and aerospace supply chain within India. So there's a lot of focus on it from my companies, a lot of focus on it from investors that I speak to in terms of India and the investment in India. I'm going to be in India actually next week at our Mumbai conference, meeting companies and meeting investors. So it is a core market. But I think that from an Indian company perspective, it comes down to the capability. If there is a unique, novel capability, whether it be in the comms infrastructure, whether it be in radar solutions, whether it be in missile or artillery defense and air defense, then the European countries will look at it.
Benjamin, I think we need another sort of 10, 12 minutes, and we'll invite you back. But this is such a fascinating conversation, and I really appreciate you joining us here on the program today. Thank you very much.
Thank you very much for having me. Appreciate it.
Thank you. We'll slip into a quick commercial break here. Up next, we'll be joined by Herald Van Der Linde, Head of Asia Equity Strategy at HSBC. And of course, we'll talk trade, tariffs, and markets. Stay tuned. Welcome back. On the global reset, now let's decode the state of play with respect to tariffs and what markets are pricing in, with one of the most seasoned macro voices in the region. Herald Van Der Linde is Head of Asia Equity Strategy at HSBC, and he's joining us now with his take on what's working and what's not across India, China, and the ASEAN region. From global policy unpredictability to sector-specific resilience, he will help us read the signals beyond the noise. Herald, great to have you with us here on this new program, The Global Reset. Always a pleasure. to speak to you.
Yeah, fantastic. Thanks for having me on your new show. And the Global Reset is a really good title for these days, because there's a bit of a global reset taking place around the world, right?
And absolutely, Herald. And that is my actually first question. Thank you for that, by the way, Herald. How much of this reset is being priced in properly? Because there is a bit of a reset. And if you look at markets around the world, they're a few percentage points away from all-time highs. So there isn't very much nervousness at all. In your opinion, and there's one point of view, and I want to ask you whether you agree with it, that we're probably at the peak in terms of tariff good news, and things become more contentious from here. Your thoughts, Herald?
Yeah, I really hope you're right, because, well, we've had a lot of tariff news already. Yeah, there is an argument to be made that we're at the peak, because tariffs was, of course, a sort of new topic that emerged in, February, April, March and April, really, of course, after Liberation Day. And the market is now attuned to it. And there is sort of expectations that what happens on the tariffs, that will be negotiated and that they will come down. However, that it will settle maybe on average somewhere around, I don't know, 15 or 20% or so. But I'm worried that maybe we're still going to have more news flow. First of all, we're still in that 90 days whereby these tariffs will be renegotiated. The clear impact of tariffs on pricing, on economic activity, will only become apparent, I suspect, over the summer. So that's another topic that we get back to. What the implications are for the Fed is something we will have to discuss. So I don't think we are over peak tariff yet, but you could argue that it was a shock to the markets in April. They fell a lot, and now they're more attuned to it. So whatever is going to happen, we've, to a certain extent, priced in already. So in that sense, maybe we have peak news flow, but not necessarily peak market volatility yet.
I've got that. Herald, we've spoken about China plus one and maybe India benefiting quite a few times in the past. How did you read President Trump's comments, almost a warning to Apple, that, the iPhones you want to sell in America, make in America? We've tolerated you building in China, but don't go to India. How do you read that?
How do I read that? Well, it's very easy to say. Industries are remarkably sort of stagnant in where they can move. I was sitting in Hong Kong. It's been a financial center. London has for a long time been a financial center. People said when Brexit hit, oh, London is over. Everybody's going to move to Europe, because why would you still be in London? Turns out there are all sorts of factors that allow to some sort of cluttering of these banks together. Easier to conduct business, meet each other, and all these sort of things, right? So moving an industry from one place to another is not as easy as you think it is. You could argue that Hollywood should not be in Hollywood, but should go to Kansas. Much cheaper to go there. So to say, hey, we're going to put tariffs in place and then we want these companies to go to the US is one thing. For that to really materialize is a whole different thing altogether. And if the US administration would have said, we're going to give massive tax breaks to anybody who sets up a, say, telecommunications or an iPhone plant in the US, and we're going to provide support for R&D and all these sort of things, then you say, okay, that's interesting. But the tariffs alone make people wonder, well, should I really do so? And what if these tariffs are going to be lower? I should still maybe be in India. So it's easy talk to say, let's move to the US. To do this is an entirely different ballgame altogether. So I suspect this is not going to happen that quickly.
The other big story lately, Herald, has been this sort of gathering pressure on the back end as far as global bond deals are concerned. You look at the US 30, yes. You look at the UK, Japan. Are yields on the long end heading significantly higher? Is there a bit of a breakout? And what does that mean for equity multiples, in your opinion?
Yeah, that's a really interesting one, because I think you're hitting the nail on the head here. This is a key risk to global equities. The question is why are these bond yields not going lower? Why are they sticking so high? And the answer here is that there is now a risk premium being baked into US equities, for US bonds. So the interest rates have to be a little bit higher to attract the same amount of money into the US than it was, say, 6 months ago. And that risk premium comes from tariffs and growth and sort of the new policies that are being put in place. Normally, this means that higher bond yields is bad for equities. But because this is a risk premium to the US, what we actually see, that money is flown out into the US, it's going to go somewhere else. And part of that, of course, has been emerging markets. So far, this has not been a negative factor for emerging markets. And actually, we've seen global equities rallying back to almost levels where we were in the beginning of the year. Now, that back end remains high. At some point in time, if this means that the cost of capital for equity actually goes up, that the market starts to price us in, this is not good for equities. If that comes, though, at a time when the Fed is saying, yes, okay, bond yields are higher, but we consider actually rate cuts coming forward, then that would, of course, please the markets again. But my suspicion is that these bond yields will remain a little bit high, that the Fed is going to be cautious in terms of moving interest rates. It's got inflation expectations to deal with. Inflation has remained high for quite some time now in the US. They've indicated they're not cutting yet. So if that's the case, this probably is going to at least limit upside into global equities and US equities as well. But might actually pose a risk to these markets as well that we come off as we price in these higher interest rates.
All this at the same at a time when dollar continued, the broader dollar, the dollar index, for example, is now under 99, Herald. And some are calling for much more downside here. What is your own view? I mean, that is important for emerging markets.
This is very important for emerging market. And this goes back to what we just mentioned, right? There's a risk premium attached to US assets. It seems how much we could debate about, but that means that, yeah, interest rates in the US have to be a little bit higher than what they used to be. That's what we just spoke about. And it means that the dollar is weaker as well. We've seen this happening already. It is just a sort of the adjustment mechanism that the US wants to go through. If you want to limit your current account deficits, a weaker dollar might help you in this particular process. Now, how much further do we see? We've already seen quite some weakness in the US coming through. So I think we're going to be careful to say, oh, there's going to be easily another 10% from here or so. We've already priced a lot of this in, but it might well be that over the course of the next 1 or 2 years, that there's going to be a gradual path of dollar weakness coming through. That would be positive for emerging market equities because, as I just mentioned, it means that some of the money that is invested in the US is going to diversify. It's going to go to other places in the world. And of course, emerging markets is one such pool that can absorb this. And this supports, for example, what we see in India. We see some money flowing back into India. And I think this is in line with what we see globally, that money is taken out of the US and some of that ends up in your local market over there.
Herald, we touched upon, I think, 3-4 of the hot button issues top of mind for markets today. Thank you very much for joining us. And I hope this is the first of what will be a long association on this program, that is the Global Reset. Thank you very much for your time here.
I hope so too. Thank you.
Thanks very much. Well, it's a wrap on the Global Reset for today till tomorrow. Thank you very much for staying with us. Thank you for watching.